The stock market is officially flashing warning signs with the worst performance we've seen in over 50 years. I have all the details, what you need to know, and the prognosis through the second half of 2022 right here in the video, so let's get right into it. Well, it's official. The first half of 2022 is over, and the performance of the stock market has been nothing more than absolutely pathetic, with the markets closing down yet again today, adding even more losses to the pile of losses we've already stacked up so far throughout the first half of 2022. In fact, you want to know some statistics about this? Let's run through the numbers now that the first half is over. Let me tell you the details as far as how the markets have fared so far in the first 6 months of 2022. According to the new data that was just released as of the market close, the S&P 500 is down 20.6% just in the first half of 2022, which is the worst performance we've seen since 1970, 52 years ago. That's incredible, right? Now let's quickly look at the NASDAQ. The NASDAQ is down 29.5% in the first 6 months of 2022, which is the worst performance we've ever seen in the history of the NASDAQ. Now, looking at the Dow Jones. The Dow Jones is down 15.3%, which is the worst performance that we've seen in the first 6 months of the year since 1962, 60 years ago. That's incredible. So the whole moral of the story behind all of this is the market is flashing some pretty ominous signs right now, and you certainly want to pay attention to this because when we're starting to see historic trends like this, when we're starting to see historic signals like this, you probably want to pay attention because it's telling us something that obviously we haven't experienced in a long, long time. Many decades, 5 decades, 6 decades, forever, right? In the case of the NASDAQ. So really quickly, before we get into this further, I want to point something else out that you want to pay attention to, especially if you are currently invested or you're sitting on the sidelines right now and you're looking to start getting invested once this market potentially pegs a bottom or when you feel a little bit more comfortable as in, okay, I like the price, I'm about to jump in. Let me point something else to you because this is very interesting, and with my experience watching the markets and something like this comes and happens every single time, and it's something you can rely on. At the same time, you kind of want to pay attention to this because it kind of gives you some leading indication as to what is going to be happening. Now, as I ran through those percentages, did it kind of ring a little bit of a bell in your mind thinking, wait, why is the Dow only down 15.3%, whereas the NASDAQ is down nearly 30%? Why is the Dow Jones down only half the amount of the NASDAQ? Or why is the S&P down a little over 20%, which is 10% less than the NASDAQ? Good questions. Let me explain it to you. Here's why. As these hedge funds, the institutions, big banks, investors, basically people, as they see a turn coming in the market, as they start to see a top being put in the market, and they start to see that maybe we have a recession coming in, we have less growth in the market coming in, earnings are probably going to be lower, we see massive inflation like what we're dealing with right now, they start to take their positions and roll them over into safer bets, as in like blue chip stocks located within the Dow Jones. They also start piling money into dividend-paying stocks. Here's what else is very interesting about this. Most institutions are required to be invested at all times. Well, here's what else you probably want to pay attention to. So, during high growth periods of time, it's most advantageous to put money into tech stocks like, that are located within the NASDAQ because these are the ones that have the greatest upside and they can make the most money the fastest by investing in tech stocks and, of course, those stocks located within the NASDAQ. Whereas the Dow Jones is usually like an old dog, right? It's hanging around, it's very reliable, but at the end of the day, it's not the best way to make a bunch of money really, really fast. The best way to do it is through the NASDAQ or the high flyers that move quickly, usually very volatile, and they have a high beta. Well, we understand that, right? So as these people continue to see the tops coming in on markets, they start to pull money out of the NASDAQ and all of these high-flying stocks, and they start piling them into more reliable stocks. Like I said, the blue chips located within the within the Dow Jones. Also, dividend-paying stocks. So when some of these institutions are required to be invested at all times, they think, wait, are we going to ride out the big dip coming in the NASDAQ, or should we put it more in something a little bit safer like the stocks within the Dow Jones, and while we wait, we'll still get paid a dividend? Well, generally, tech stocks don't pay a dividend. Of course, some of them do, but generally, not a whole lot of them do. Whereas the stocks located within the Dow Jones, almost every single one of them pays a dividend. So essentially, they get paid to wait through dividends. Of course, they're going to lose a little bit of money based on price action, but at the end of the day, they still get paid to wait. Investors do, while the market kind of turns over and goes back down, and then they can reverse that, pull money out of the Dow, and then pile it right back into those high flyer NASDAQ stocks. Kind of makes sense? So that is why we're seeing this massive rotation here, where we're seeing a lot of money being pulled out of the NASDAQ, and the NASDAQ is down nearly 30%. Meanwhile, the Dow is only down 15%. So technically, according to these percentages, the S&P 500 and the NASDAQ are officially well within bear territory, like bear market territory, whereas the Dow Jones, it's not. It's still in correction territory. It's still about 5% off from bear market territory as defined by the 20%, right? So anyway, I wanted to point that out because it's very interesting. Here's something else I want to point out to you as well. When you start to see the Dow Jones, again, underperforming, because right now it's outperforming, right? Because it's not falling as fast as the others. When you start to see the Dow Jones underperforming and the NASDAQ and the Russell 2000, which by the way, I didn't mention that yet. I can talk about that more here in just a second. When you start to see the Dow Jones underperforming and the NASDAQ as well as the Russell 2000 starting to outperform, you might start to see a little bit of a rotation back in to these indices. So something else I want to point out here about the Russell 2000. I like to watch the Russell very, very closely because to me, this is one of the most indicative leading indicators going into the market. Here's why. The Russell is very volatile, especially compared to the Dow and the S&P. Of course, the NASDAQ is also pretty volatile, but at the end of the day, the Russell is, one that I like to watch very closely because this is all made up of small caps. In other words, when we're looking at the potential of a recession coming or a major dip in the markets, are people going to keep their money in like safe, reliable, big companies that have been around for 30, 50 years, something like this? Or are they going to keep their money in small companies that are still very, very small, have a teeny tiny market cap, and could possibly go bankrupt literally at the snap of a finger? Yeah, they're going to pull all their money out of the Russell stocks, right? So this is something that I watch closely. Now, generally, the Russell 2000 and the NASDAQ lead the market in either direction. Here's why. Because again, when it comes down to the time where the market's going to start rolling over, they want to start pulling their money out of these companies because these are the ones that are most vulnerable. At the same time, when we potentially peg a bottom in the market, these are generally the indices that turn around and rip higher very, very fast because, again, they see growth potential, as in investors see growth potential within the stocks located in the Russell 2000 and, of course, the NASDAQ, start piling money in because these are the ones that typically run much higher, much faster, and has the opportunity to make a lot of money much more quickly versus putting money in the Dow, which is just really slow and sluggish and doesn't really do a whole lot, right? So I like to watch the S&P 500, I like to watch the NASDAQ, and of course the Russell 2000, all of which I like to watch as indicated by the ETFs, which is the SPY, QQQ, and IWM. So anyway, just want to point those out for you really quickly. Now, let's quickly talk about what is the prognosis going forward. Well, as I mentioned just a little while ago, we need to watch these indicators because here's the thing. As we're starting to peg some of these massive drops in the market that we haven't seen in 50 years, 60 years, or in history with the case of the NASDAQ, do you think this is an indication that maybe there's, maybe a little more pain to come? Yeah, you better believe there's going to be, right? Now, here's the thing. Over the last, week and a half or so now, we've been seeing a little bit of a bounce in the market. Now, I want to be, again, first off, I want to say this much. This is not investing advice. I'm not here to tell you what to do with your money. I have no clue what your situation is, and I can't tell you how to invest your money. However, I do want to point some things out to you because I've been watching the market for quite a few years now, 14 years, and I've been watching it very, very closely. I see these same trends continue to pop up all the time. Here's what's happening. As we continue to see what's currently going on in the market right now, the market went down, right? We pegged off of the bear market. We dipped into it a few times. We've been bouncing around. We dip in, and then we kind of pop back out. We dip in, and we pop back out. So this current situation with what's going on as far as this little rally that we've been seeing, depending on what you're looking at, we might be up maybe 2%, 3%, maybe 5% in some cases. But here's the thing. This is nothing more than a bear market rally. So when we're coming off the top being put into a market, generally what we see is a nice little drop in the market, like what we've seen so far, like a 20%, something like this, bringing it down, pegging bear market territory, and then we get a nice little healthy bounce because all the buy the dippers out in the world step in and say, it's buy the dip time, right? Well, yes, it works until guess what? It doesn't work anymore. And that's the case that we're going to be in here very, very soon. So generally the first drop after the top is put into a market is pretty substantial, but at the same time, it's not like a crazy big drop, right? In this case, that's exactly what we see. And now we get the bear market rally, right? So that's what we're seeing now. Again, I want to point this out to you. The bear market rally is generally the first indication where the tide has turned here, and now it is time to start maybe thinking about selling the rip rather than buying the dip, okay? So for all of you out there who are walking around with t-shirts and talking about buying the dip on social media, I would highly advise you to change your tune on this and start saying sell the rip, which by the way, maybe I should make a t-shirt real quick before somebody else does, because this is going to be the new lingo going forward here for a little while. Now, when we come out of this bear market rally, here's what's likely going to happen. This is going to be the next big leg down. Here's what happens with the next leg. The next leg in this market is usually going to be a big one. Big drop. Okay, so I want you to be aware of this. Again, could I be wrong? 100%. I could be 100% wrong, or I could be 100% right. I guess only time will tell, but we'll have to see what happens here. But generally the second leg down in a market like this, in a newly fresh pegged bear market, is usually the big one, okay? So the top is put in, a big drop comes in, a bear market rally follows, which is what we just wrapped up there, and then the next big leg comes in. So likely what we'll see is the prices come back down, retest those lows that were put in, maybe a week and a half, 2 weeks ago or so. Once we retest those lows, we're probably going to get a little tiny bounce. Maybe it's going to base around for a little while. Once that kind of fades out, look out below, because this sucker is probably going to have the rug pulled out. And we're going to see all this going out here going forward too as well, especially with the aggressive policies coming out of the Federal Reserve, right? This is something else we want to pay attention to because the Fed right now is raising interest rates very, very aggressively. Now, is this, positive for the markets? No, it's not. The markets don't like this. Markets like certainty, or closest to certainty as we can possibly get. Is jacking up interest rates at a rate of 75 basis points per meeting certainty? No, it's not at all, because this is going to crush the economy. They already know this. This is a manufactured crash. So here's the thing. The Fed has already decided they're going to crash the market, they're going to crash the crypto, they're going to crash the stocks, they're going to try to bring down the real estate market by jacking up interest rates on everybody. So they're going to try to bring down these markets to try to tame prices down. They've already decided this, and the whole objective behind this is to bring down all this inflation. Is it going to work? Well, in my opinion, I don't think it's going to work. But again, only time will tell on this. I don't think the strategy that they are currently using is going to work for the problems that we currently have in front of us. But this is going to lead to some massive opportunity in the stock market when this thing rolls over and they do the rug pull, and all of a sudden you see, the bottom fell out of this thing, and now we're going down real fast. So here's what I would anticipate, and I want you to pay attention to this. Do you remember back in the days of March and April 2020? I hope you were watching the market back then. Well, here's what happened. In the course of about 3 weeks' time, the market collapsed big, right? You saw that. If you ever looked at a candlestick chart or anything like this, it is literally a red line going straight down, okay? So we're likely going to see another situation very similar to that. We're going to get the rug pull, and all of a sudden, whoa, what happened? The whole thing's going to have a big collapse onto itself. So when this happens, look for a capitulation, okay? It's going to come in fast. There's going to be a major bottom that's going to be pegged, and this is likely what's going to happen going forward. It's probably not going to be this recession that we're looking at right now. It's highly unlikely going to be one of these long, prolonged recessions that hangs around for 2 years and forever, and we have really sluggish growth and things like that. This recession that we're looking at right now is likely going to be another pretty swift recession, just like what we saw in early 2020, where things come in, they do the rug pull, and all of a sudden they say, hey, just kidding. We're going to print a whole bunch of money now, and we're going to pump things back up. Just kidding. We were just trying a little experiment here, guys. So when they pull this thing again, be ready, okay? Do your research now. Find out what you want to buy. Be prepared to get your finger on that buy button and be ready to get in when you see capitulation coming into this market. Here's the thing. When I see something like this happen, I'll come back with another video and say, hey, here's the capitulation. Here is the buying opportunity, okay? Now, don't get me wrong. I totally understand that money is really tight right now for a lot of people. So I'm not suggesting that you got to have tons and tons of money to do this. If you have any interest in getting into stocks, crypto, anything like this, I mean, literally, you could buy anything for very cheap. I mean, seriously, there's crypto out there that you could buy for, $5 and you could get all kinds of crypto. I mean, seriously, the markets are set up for basically everybody to participate. But anyway, the major whole moral of the story behind this video is simply that this is the worst performance of the market in the first half of the year that we've seen in 50 years, 60 years, or in the history of the indices when it comes to the NASDAQ. The fact of the matter is this bear market that we are currently in right now is far from over. The bottom is not put in. It's not even close to being put in. Based on what I'm observing right here, I would not be surprised at all to see another 10, 15, 20, even 30% drop in this market, but I would anticipate the next one is going to come fast, okay? A big drop fast, and it's probably going to come in. It's going to come in quick, and it's probably going to leave just as quickly, right? Now, generally, the markets fall significantly faster than they actually rise, but at the end of the day, you still got to be prepared for this. Anyway, hope this one kind of gives you a little bit of a glimpse into what's going on here. Some big major warning signs here on the horizon. Some major storm clouds coming in, just like Jamie Dimon said, who is the CEO of JP Morgan, maybe about a month and a half or so ago. He was talking about an economic hurricane. Yeah, when people like this speak, you probably want to listen because this dude knows what he's talking about. He's been around the block a few times and he knows what is going on. When you hear Jamie Dimon, the CEO of one of the biggest banks in the world, coming out saying there's going to be an economic hurricane, you probably want to take that into consideration, right? So anyway, of course, I'll be right here for you, watching everything closely. As I do get more details, I'll be right back here for you, breaking it down. And as I see the opportunities come in, as far as potential buys, you might want to, make sure to subscribe down below so you don't miss any videos going forward. And of course, any rallies higher, just give us even more opportunity to, pull out the shorts. Just saying, if you know what I mean. Not shorts that you wear, short positions. Anyway, again, this is not investing advice in any way, shape, or form. I'm just some dude on the internet, so you never know. Maybe I have no clue what I'm talking about, but I can tell you this much. I've been watching the markets for a very long time now. I know how this stuff plays out because I've seen it play out time and time again. It's the same old song and dance every single time, and they're going to do the rug pull on us, and again, another opportunity will be in our lap. So please make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out some of the thousands of videos right here on the channel. Enjoy your day. Until next time, have a good one. Stay tuned. I'll keep you posted as I see the opportunities arising, and I'll catch you again later, and I want to help you grab some more money and anything else out there we can get our hands on.